Mr. Quast, what is your first of all? Good morning. Hope you had a great weekend.
Good morning. Yes,
What
we
what is your
bikes.
take on the shellacking of last week and last month?
Uh, it's interesting because you could take two positions along a spectrum, or I suppose anywhere uh, between them. So we're either going through what Dennis said, and I agree, Dennis. I would go back to May of 2021, where as the way we measure broad market sentiment uh, works, the momentum market ended, and there's a
Yeah.
big gap between cause and effect, because it's a big market and it takes people a while to get there. So on one hand, you could say this is just a normal, natural, healthy process of resetting valuations to reasonable levels, to your point about Tesla, 900 billion in market cap. Uh, or or you could go to the other extreme, and it's possible. I'll float the idea, and I did this over the weekend with a couple of folks, traded notes with them. I said you could also say that we're in a full-blown financial crisis, and we just don't know it yet. We have this way of looking around for the signals that will tell us, well, these are the things that have to happen for a financial crisis to occur. But I think that prudent people should look at it so that you're not caught out. I'm not inflating the downside. That seems counterintuitive.
What
But
makes you
I'm saying
think?
that we should think about that. Well, because the Nasdaq had its worst week since October 2008, and I was listening to Mohammed Al-Arian this morning on
Muhammad's
CNBC.
awesome.
Yeah, he's a very, very bright guy, and he pointed out that if you look over the last year, so we increased the supply of currency by 2 trillion over the last $2 trillion over the last year, and now the Fed is contemplating reducing it by $500 billion over the next year. He said, well, that's a $2.5 trillion swing. What effect does that have on financial assets? Well, we don't know. I mean, you could look around the planet and say that there are things to be concerned about. That the yen is at a 30-year low versus the dollar, and they seem happy with that. The dollar has the strength of that it would have during a financial crisis when people are looking for a place for shelter. The eurozone has really slowed down. China has slowed down. So if you looked at all these things, wouldn't it be something? And it's part of the natural cycle for economies. And a bunch of the audience here probably has never been through something like that. They're that young,
Yeah.
but you have to think about the fact that we have these signals that could tell us that we're right on the edge, just entering a financial crisis. And it has to do with the extraordinary effort that we took to prevent one during the pandemic. Well, you can delay it, but you're still going to have to go through it. So somewhere in between those two is where we are, I think,
Well,
Spencer.
well, and there is a good point to be made there. You could take it back even further than that. I mean, look at what they did in 2007, 2008, and 2009. Did they change anything, or did they just throw more money at the problem? I
Right.
mean, we kicked the can down the road back then as well. And now we've been, kicking the can for another 10 years. And then we really started booting the can hard during the COVID crisis here. I mean, they've given the market so much liquidity and so much free money that you're taking some of that back, it's got to have some repercussions.
Absolutely. What we used as extraordinary measures to prevent the collapse of the global payment system
We did.
in 2008. What that means, by the way, people, is that, and traders, this matters to you because what you do in the equity market, because we're talking about short-term trading as opposed to long-term investing for the most part on this program. I mean, there are
Yeah.
occasions when we don't, but what that means is that you could go to the ATM and nothing would come out. So it was that severe. And then the policies that we used to address something of that severity became normal policies. So at some point, there will be a consequence from that. I realize that the modern monetary theorists believe that there are currency creators and currency users and that you can balance those things out. But I think that we're experiencing the fact that you cannot deprive people of the value of their currency by creating too much of it, and everything will just work out. What will happen is you will form bubbles. I would call it a pandemic bubble, where all the stuff that thrive during a pandemic when people are working at home and their behaviors are altered, traded at extraordinary, extreme levels. And then the air comes out of that. And at the end of it, you realize, well, I have less capacity to consume things now than I did before. And that's a condition that we're going to have to address. I mean, Workhorse is trading at $3. There's an example.
I mean, there's a bazillion examples of that in the growthy tech, the story stocks column. What
Yep.
was a cool story in 2020 and 2021 that was just going up, and it didn't make money. All of those stocks, anything storied, really, really got hit the hardest. But
Yep.
they're coming for the value stuff now too, Tim. I mean, we've seen a turn here in April. It wasn't ugly for a lot of stocks. A lot of commodity stocks were making new highs in March. I mean, you had a lot of value names that were just, seemingly going up forever, and it seemed like
Yep.
the place to be. But it's turned there too now, and maybe we should jump into Market Structure Edge and start looking at some of these value stocks. Maybe it's just go, can you look at Berkshire Hathaway? Is that a stock in your universe to look at? Because it's not really a stock.
Should be. Let's
maybe we
see
should look at that, because here, we were talking about how good Warren had it, how good he was doing.
Right.
I couldn't even understand. Apple was going down, but Berkshire was still coming up. Well, that tune has changed here now.
It could have been because he was buying.
Maybe. But we're 360 down to 320 here in the course of about 5 weeks. I mean, that is a tidy little 15% sell-off for the world's greatest investor. I mean, 12 or 13%. So Berkshire has now turned as well too.
So we have the B shares. The A shares.
That's good. The B's good.
From a market structure perspective, I wouldn't buy BRK.B right now, because demand is falling and supply is rising. Those things don't tend to produce gains. But if you backed up, clearly this was a great time where demand is soaring and supply is declining. That's in any market, traders. Here's your great lesson. Wherever the money is, that's where you want to be. And then you trade the things that have the best supply demand characteristics. And here's a way to look at it. So, Edge Mob, you will know this, but here's what you would do. You say, consumer staples might be a good place to be. If I look at the supply demand balance, it's not great even for the whole group. There are 133 stocks in it. But you could do this. You could say, well, let's go look at the whole group and let's isolate down to the things that have rising demand and constrained supply. So that's what I would do. And I'll tell you, this is kind of interesting. So I would come over here to the D trend, the demand trend, and say, I only want stuff that's going up. I might make a couple of other adjustments to this, but I only get 8 stocks. Right? Even in
out of 132,
oh boy,
you get 8.
It's 8. There are only 8 of them with rising demand, and I would look at them and say, well, out of these, there's a down, a down, and a down. So if I'm looking at the data, and that's a 1.8, so I'm not buying Cody, even though you could say, it's a consumer staple. Are people going to buy makeup? Probably, but it's a 1.8. I look at this and say, well, price smart is a possibility. 63% supply, not doing it. So then I'm down to really Lifeway. I mean, there's
one
there's
stock
one stock
out of
and maybe-
132.
out of all the stocks, I would say there's one stock that would interest me. See that? Rising demand, falling supply. There is one stock that has a reasonable probability of rising right now out of 133 in the place where the money is going, consumer staples. That is a great barometer for the market. It tells you something. Now, I think we could get some new money. There are people, including myself, although we're packing stuff in cash. I've asked our long-term, our financial advisors, hold stuff in cash. I don't want to just throw it into the smoking hole in the ground, but there are going to be inflows from retirement plans that tend to come in the first part of the month and they get deployed. So you could have a couple of good days. But I look at the data and say, one of my favorite lines, the prudent foresee evil and hide themselves. If I can only find one stock out of 133 in the sector where the money is going that looks good, well, then you should go to Charlie Munger. You don't want to do stuff that makes you look bad. So, right now, I think it makes you look bad to plow much money into the market.
And it makes you look bad to call the bottom because, I mean, I've tried a couple of times here. I think we're getting a little bit of a turn. I'm going to try some stock longs. And then all of a sudden, it's like, oh, it looks good for about 2 hours. And they pull the rug out from under it. It's like, I just got caught in yet another suckers rally. I mean, there have been so many in the last year, really. Even we can talk since November for the majority of stocks, but obviously in the growthy names, it's been 16 months since a lot of these stocks have topped out, and every rally has been a suckers rally.
The NASDAQ is now, for the trailing year, the trailing 12 months is down about 8%. And so the S&P 500 is now down for the full trailing year, which is a remarkable thing when you think about all of the people who are trading, and the explosion from about 65 million retail trading accounts at various firms to, at the peak of the pandemic frenzy, there were over 100 million retail accounts. That's come down a little bit, but a lot of these folks, and look, some of you are listening to this and thinking, this has been a disaster. Well, it's welcome to the yin and yang of the stock market. I got a kick out of something that, and that's not that I'm neither a fan nor not of Warren Buffett and Charlie Munger. And for those of you who didn't follow that, Berkshire Hathaway doesn't hold an earnings call. They put out a press release on Saturday, and Warren Buffett holds forth holds court one time a year, and describes what they're doing. And they publish a 10Q that talks about their positions even before they have to report them for the quarter. That would be about the middle of this month, following the 13F regimen in the market. And they don't have an IR person, but they sit and talk. And so, Charlie Munger said we've had a lot of people in the stock market who don't know anything about the stock market, who are being advised by brokers who know even less. I'm not sure how much of that is true, but it's, there's a point here about making sure that you understand what you're doing. And as a self-serving plug, that's why we launched Market Structure Edge. It's to help you understand how the market works today. And I do agree that intermediaries, there are so many intermediaries in the stock market, and they all make money. Well, you don't. There are all of the market, the whole system is built around market making. A broker will be a party to every transaction, and then many of those before you are even party to them. And so 60% of trading volume comes from parties who are just supposed to be advisors, not participating in the market. And then you got the stock exchanges, the dark pools. All of these are the shareholder owned or broker operated middlemen who take a little piece. And when you have so much intermediation, they all do well and you don't.
It's been the way for so long, and I mean, it's just kind of moved. Like if you think back, the intermediation going back 30 years ago, your stockbroker would take 1% in, 1% out, or maybe it's 1% or 0.5% and 0.5% out, but 1%, like you put 100 grand something, they take $1,000 for making that trade. That sounds like so archaic, like so like long, but the intermediation just changed. I mean, the money now it's gone, and obviously we know payment for order flow facilitates that, where they can make the spreads and obviously rip off the liquidity providers. I mean, this is just kind of moved where this intermediation is still there. It's just kind of changed its form.
I completely agree, and a great way to see this. So you'd say 1% is just horrible, right? Well, why would we pay 1% for something? And well, think about it this way. It's a metric that we put on the Edge platform. We track intraday volatility. I think it's a great way to think about that the amount of money intermediaries are making. So here's the EV group, and there are 13 components here, and Tesla's about in the middle, 2.6 and trending down, 44% short. I think it actually is down to about 38 now. So all the shorts are covering. But look at this volatility category. Let me zoom that in. So that is the amount that the price moves from high to low every day. That's what people are making off of you. You could take
Yeah.
Roughly 60% of that. So you say, well, 1% is I'm just getting jobbed. No, you're not. You're getting jobbed by the market. That's it. And I used this example last week in the demo for edge users that, if something has divergent supply and demand and its intraday volatility is 4% and it goes down 4%, I'm buying that. Why? Because there's almost 100% chance that I make at least two, because it will recover because intermediaries know the spreads. They know the ranges and they're going to make money on that. So it's something you should know, traders. You should know how much the price moves, because you can use it to your advantage just like they do.
All right, Tim Quast, marketstructureedge.com, link in description. I highly recommend everyone check it out. Tim, have a great one. We'll talk to you again next week.
Sounds good.
All right.
See you guys.
Thanks.